Managing Director and Senior Research Analyst at Baird Equity Research. Michael, thanks a lot for joining us. You have noted that the fourth quarter results were better than expected, but guidance will be the near-term driver of these shares. What did the company say in its forecasts and guidance?
Good afternoon. Thanks for having me. The big driver of the shortfall, and it was a little bit of a shortfall, was really FX. Bookings are predominantly international-based business, and obviously currencies have moved a lot. And when you peel it back, the constant FX outlook is pretty much in line with what we and others thought, and with the company's kind of medium-term growth outlooks of 8% growth on the top line, 15% earnings per share growth. And it's really just FX. And a lot of times the market looks through that. You mentioned the stock was up. Fourth quarter results were really strong. Not totally surprising, given what we've seen so far from Expedia, Airbnb, some of the other hotel brand companies that we cover too, but it was really FX. There's no other fundamental gotchas that we heard yesterday.
The company Booking is the parent of Kayak and Priceline, among other travel-related booking sites. What is the current state of travel demand, and is it being affected at all by the talk of tariffs where there's some fairly significant worry of an economic slowdown?
Yeah, the tariff conversation is kind of a good water cooler conversation right now. Management teams aren't seeing that; they're not hearing that. In terms of travel demand globally and domestically here in the U.S., I think it's simple. People have jobs, people are spending money, and they're going on vacation. Some of that's a little bit of a post-pandemic. People have more time, more appreciation for travel and experiences, but the underlying trend is pretty good. I would just say the fourth quarter growth rates that Booking put up, that's not the true underlying run rate for the entire industry, but overall trends are pretty good, and consumers are healthy, and consumers are spending, and they're going on vacation, because they have a job.
How should investors or shareholders in the company think about the potential competitive threats from artificial intelligence? I believe the company has addressed that topic, at least on conference calls.
Yeah, I think that was 3 or 4 of the 6 questions yesterday on the call. You got a knee-jerk reaction a couple weeks ago when that headline hit. There's always a little bit of a shoot first, ask questions later when people think about some existential threat to a potential business. I like the way that they answered it, where at one point in time it was Google, at one point in time it was the hotel brands taking back a greater share of direct bookings. The business will evolve and they'll adapt. They're investing heavily in technology and AI too. And I think the thing we all think about is potential revenue disruption. It's certainly possible, still early days. What about the other side of the equation too, on the expense side? Operational efficiencies, more targeted marketing, less direct advertising costs to Google perhaps. So there's puts and takes on both sides. It's still early days. And this is, I think, at least right now, sort of a classic example of initial knee-jerk reaction, and it will probably be a little less bad than we think, and it will take longer to play out than we all think right now.
So you may have maintained an outperform rating on the stock. You have trimmed your target price to $5,725 US per share. Big numbers in this case. No stock splits in the recent history here. So the target price goes down by about $125 on foreign exchange issues that you've addressed in our conversation. What kind of valuation metrics do you use to get to $5,725 US per share as a target price, which would be 10% plus upside from here?
Yep, 10% plus the little bit of dividend. Price target's down about 2 and change %, and our EPS and EBITDA estimates came down a similar amount. So 24 times earnings is sort of our baseline, how we think about valuing the stock. The market's trading at 20 times right now, so a 20% premium, and historically, Bookings traded sort of in line with the market to a 30% premium. So just above the midpoint for a business that's growing solidly, despite FX headwinds, has a pretty robust global demand, kind of secular travel tailwind. So we think 24 times is appropriate. And historically, too, you look back at the company's execution and delivering results, they've for the most part met or exceeded expectations too. So my sense is as long as the macro economy holds up, there's probably an upward bias to numbers throughout 25 as the year progresses.
Michael, thanks a great deal for